Okay, the next one would be capital commitments. Okay, under capital commitments. So just now, contingent liability is the liability part. Capital commitment is actually talking about assets. Okay, side. So in terms of capital commitments, normally it's the responsibility for the management again to identify, evaluate, and account for your capital commitment. So as an auditor, you need to be able to ask your client, is there any capital commitment, okay, that incurred by the company? Again, the sources of the information, of course, from the client directly, and secondly, from the client's correspondent or contracts, okay, or additional sources such as corporate minutes of meeting, correspondent between supplier and contracts, okay, or strategic planning documents and minutes of the board meetings. Okay, what can you get with regard to the capital commitment? If you were to refer to the strategic planning meeting, you might found that company is actually having a commitment to purchase a significant machine. For instance, the cost of the machine is actually 2 million. Okay, so you know that in future, soon the company is actually going to invest, okay, to buy that machine and cost the company of 2 million. So it's a big amount of commitment. Okay, so you might want to disclose that, all right, because it will, of course, after all, it will also reflect their liability. Okay, and then at the same time, all right, while you go through the correspondence between suppliers or contractors, okay, this is quite common for the companies who involve in the, for instance, like commodity. For instance, airline company. Okay, for airline company, what will happen is that in order to minimize the risk, okay, for the price fluctuation of the oil, so they will hedge. Okay, they will do hedging, and they will actually book certain amount of quantity of fuel to be purchased on certain date at certain value. Okay, so therefore you would actually have a committed, okay, to actually purchase this particular fuel at this particular value or ringgit or dollar whatsoever and certain quantity. Okay, so that is their commitment. So again, this would also reflect, okay, what would be the money that going to be outflow. All right, so and sometimes they purchase in bulk, in a big amount, big quantity, right? So this is also will be reflected as a capital commitment. And then the next thing will be, sorry, by the way, for the capital commitment, normally we don't make adjustment to the financial statement, but we normally just put in the disclosure in the notes to the accounts. Why? Because on the prudence concept, we always go for a prudence concept, means that we record liability, but we only take note of the assets. Okay, because the different nature of the between assets and liability. Okay, review of significant estimate. Okay, this is talking about estimation. Okay, estimation. So this is actually a big area where manipulation of the accounts is actually happening in the real life, because this is the way that where the company is actually managing their earnings. Okay, managing their earnings. All right. So earnings means their profit, their sales, their performance. All right, to ensure that they would have a smooth performance from year to year. All right, they don't want to show that very abrupt increase in the sales for this year, though they have very significant increase, but they try to manage their earnings like increase steadily over the years. So how they do it is actually through earnings management or estimation. So involve a lot of provisions and accrual sections. All right. So that's why when you ask your client, how do you estimate? All right. Okay. So in nowadays, a lot of area exposure of this thing could happen. Okay. So one is area of liability, and another one is the impairment of assets values. So it can happen on the both side, assets and also liability. All right. So because nowadays when we're talking about fair value, people will actually come to their own estimation, interpretation. This would be the best value, fair value for this particular assets. So how do you know? So they say that this one we get valuation from the valuer. Okay, so that one fine because it's supported. But some say that, oh, I dreamed last night, so this is actually the value. So we have to look at actually how management do estimation. So what do we need to do is that as an auditor, we need to ensure that when they decide their estimation, it is actually reasonable. That means they must have a basis, okay, and how they compute, and is it accurate or not? Is it reasonable or not? Okay, so as an auditor, we actually go and get the example of the basis of computation, what are basis and assumptions that they use, and we also refer back to FRS, MFRS, how is actually a certain item, because when you're talking about liability, when you're talking about assets, there are specific item, right? Okay, for instance, like investment. Okay, so in the MFRS, they already mentioned specifically how do we actually evaluate, okay, the estimation fair value of this particular investment and so on. So it must be in accordance to the financial reporting standard. So in evaluating the management estimate, auditors need to concentrate on the key factors, basis and assumptions, and also calculations. So we get the work, all this information from the client, and we do reasonableness test. Okay, and then we actually test all this estimate accurate or not. Okay, is there any deviation from the historical patterns, okay, of the industry, any misstatement or not? Okay, any inconsistency to the current trend. So you have to know the external factors that happen within the industry, economy, world, and so on. So you evaluate your reasonableness of the computation just now, and consider, is there any required for relevant disclosure or not? Okay, so when you do your test on reasonableness, maybe could have an impact on the financial statement. Okay, it could have impact on the financial statement. So then maybe adjustment required. Okay, so again, based on the audit procedures, therefore you need to know what auditors need to do. Adjustment to the financial statement or not, disclosure to the notes to the accounts or not. The next one will be assessing subsequent events. Okay, subsequent event is the events that happen after balance sheet date. Okay, which requires special attention. So these are the events that happen. So the first thing, cut-off date, as I mentioned just now, between the client's balance sheet date and the date of the audit report, between the audit report but before issuance of the financial statement, and after issuance of the financial statement. What would you as an auditor need to do if something happened within this time frame? Okay. So as an auditor, we have to look at this particular time frame or cut off between the three different cut off. Okay, what are the example of subsequent event? Many things could happen. So one customer, major customer file for bankruptcy. Okay, so that's why when you understand the business, you need to know who are the customer of the client. Right, because sometimes you notice that the sales is actually mainly done to one particular customer. 70% of the sales is actually only go to one customer. So what will happen is after year end, this customer got bankrupt. Okay, because of the COVID-19, customer got bankrupt, and so when it is bankrupt, can you get all your receivable amounts? Okay, so what happened to your financial statement? Okay, it will destroy, isn't it, your financial conditions? Let's say 70% of your receivable from the 1,700,000 cannot be collected. So it will eaten up your profit by 700,000. What will happen to your performance? Okay, lawsuit settled for different amount than accrual. Alright, you accrued for 1 million, but you have to settle for 2 million. So you have additional 1 million extra to pop up. Okay, again, liability exposure. A sale of inventory below carrying value provide evidence that net receivable value was less than cost at year end. So that's why when you do test of inventory, it's very important actually, right? NRV test, because to ensure that the fair value of the inventory is actually reflecting the actual value that it can be disposed after year end. Alright. Uninsured casualty loss that occur after balance sheet date. For instance, at one time in Thailand, Toyota in Thailand, They produce all the car as usual and they put in the compound, and one particular day major flood happened. So all the car is actually swept into the water, okay, the flood water. So if you did not insure all this, can you recover? Is that actually a major loss to the company? So what will happen to the financial statement? How would you record your inventory at that time? Okay. And then major decision made during subsequent period. Okay, sometimes that's why it's very important to look for minutes after year end, because we want to know is there any major decision that actually made. Okay, because sometimes merger, okay, or merger happen, acquisition happen, or sometimes you stop or you discontinue certain business whatsoever. So a lot of things could happen, okay, in the board meeting. So that's why we look at the minutes of the board. Okay, or any material change occur in the value of investment. So lots of things could happen. Okay, significant drop of your stock market, your market value of the company. So what will happen? So audit procedures, what do you need to do? So you have to read the minutes of the meeting, okay, and then you have to read interim financial statement. Interim financial statement is actually referred to financial statement after year end. Alright, so if you audit for the year end 31st December 2020 and you are in the company in the month of March, therefore you would actually have to look for financial statement up to March 2021. You want to see what is the status of the company as at that particular first quarter of the year, okay, to know the performance of the company. Is there any significant changes or not? And of course, always involve a lot of inquiry to the management with regard to the significant changes in the financial statement, with regard to the contingent liability, working capital, okay, so, and any unusual accounting adjustment made after balance sheet date. So that's why a lot of running of journal and testing on the journal entries. So that's why a lot of audit firm nowadays using the audit tools. They use the tools to analyze journal entry or transactions in the GL, right? Just to detect any unusual adjustment or posting of transaction happen before and also after year end. So these are the where a lot of adjustment is actually being made. Okay, because normally before year end you do the posting to the financial statement. After year end you do reversal, okay, to the financial statement. This is actually what happened in reality. Okay, so that's why we go through a lot of. So these are the audit procedures that normally auditors need to do. Okay, so based on the audit procedures, then, okay, what auditor needs to do? Conditions that occurred between balance sheet date and date of the audit report. Therefore, you perform the audit procedure, then you identify. Again, adjustment required or not, or maybe disclosure only required or not. Okay, but if conditions that occurred after the date of the audit report but before the issuance of the financial statement, actually no obligation for the auditor to conduct the audit procedure. Okay, however, if the event is significant, then maybe adjustment required. Therefore, auditor would actually discuss with the management, perform relevant audit procedures, then perhaps issue the revised audit opinion. Okay, revised audit opinion. So auditors can still do that. Okay, that means you reissue your audit report. Okay, because now it has not yet been published, okay, in the annual report. Okay, and then what will happen if now the issuance of the financial statement, okay, has occurred? So again, for the auditor, no obligation to conduct audit procedure, but shall adjustment required, meaning that it's a very significant subsequent event. Then again, you might want to discuss with the management what need to be done. And if let's say there are some adjustment required to the financial statement, which actually happen in reality, because sometimes when you receive, last time when you receive your annual report, you can see addendum. Okay, additional page that being attached to the annual report with the addendum, whereby they would actually show that the restated of the financial statement or certain figure and so on. Okay, so what will happen if client did not cooperate? Okay, what will happen if client did not cooperate? So you have, because now you are responsible for that financial statement, for that audited financial statement. You already signed the account. So now when something happen have impact on the financial statement which already being audited, so you have to report, okay, that to the regulatory or authority to say that, okay, that financial statement is actually invalid because there are some changes due to certain events that happen. Okay, so you have to notify certain user, especially those charged with the governance, okay, because normally most of the time those that use your audited financial statement will be company and also shareholders. So you would actually need to notify all these people that the previous audited financial statement is no longer valid. Okay, no longer need to be relied on because there are some changes to the figures. So you have to know what are the auditor's responsibility in the case of when something happen, what are the audit procedures that you need to be done, and what is actually your actions need to be taken between you and the management. And if let's say some refusal, management refuse, okay, to assist you, then what are your roles or your responsibility that you need to do. Okay, so that is with regard to